Now, let's move on to something else, the floor and ceiling method. So, you know, ideally, what we want to do is we want to buy the outperformers and we want to sell the underperformers. So far, so good. This is what everybody wants to do. So we want in any index, like whether it's the S&P, whether it's topics, whatever you name it, you want to buy the outperformers, sell the underperformers, make money on the delta. So this is what it looks like. And this is a method that I've developed, and this is a method that actually pretty much, I'm pretty sure that everybody instinctively does. Come on. All right, here we go. So we'll talk about the swings, how we collect the swings later, but absolute versus relative, this is an important point. So what we need to concentrate doing the relative is you will always have an ample supply of shorts and longs, and the money is made on the delta. So let's say, for instance, you buy Amazon, you short GE, that's it. The money is made on the delta. The relative shorts are never crowded. Now, one thing that we see here, for instance, when the market goes up, there are very, very, very few shorts in absolute. I can guarantee that everybody's looking at the same shorts, which means that those shorts become very, very crowded, which means that everybody comes to them, which means that the borrow is expensive, they're very volatile, everybody knows they're short, nobody's out there to buy them, which means that the volatility increases. But because there's so few of them, what happens is that people take big positions. Now, what happens when you take a big position on the short side with a volatile stock? You are very concentrated on the short side and diluted on the upside, on the long book, right? So what happens is, because you're very concentrated on the short side in volatile stocks, the volatility of the short book starts driving the volatility of the portfolio. Everybody follows so far? So if the volatility of the short book drives the volatility of the overall portfolio, what happens is you have an overall volatile performance. And clients, customers, they pay to have low volatility. So there's obviously a natural difficulty. Whereas if you do it on the relative side, you never struggle. You short your food, you short your whatever, you buy your long tech, whatever, market starts to get a risk off. All right, let's go long utilities, let's short some NASDAQ. Here we go. And rotation, 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 rotation. Another thing about shorting absolute versus relative is when you short relative, every stock in the world is the same. Every stock in the world is the same. You have, let's say you're on the social media side, you have Facebook, Twitter, what is that, Byte Time, all these guys. So there's like when one stock underperforms, like example, Twitter, for instance, Twitter underperforms Facebook and the other ones, LinkedIn and whatever you name it, I don't really know, starts to underperform its peers. Then it underperforms its sub-industry. Then it underperforms the industry. Then it underperforms the sector. Then finally, it underperforms the market. And then finally, it starts to go down in absolute. So for all the people who go out short selling in absolute out there, I won't give you my address because I know that it's going to make you very angry and you're going to wait for me downstairs trying to break my teeth. I don't like that. Short selling in absolute is a laggard indicator. And there's no worse insult for anybody on the market to be called a laggard indicator. So short relative, it's easier. And you will look super smart because you will be ahead of everybody. So moving on. And another thing that is important when doing, everybody still there? Questions? Without questions at this point?
Yes, one question from Asim is, so for relative shorts, do you short the stock and long the index? Or do you do it in dollar neutral terms?
Right, good question. So, okay, Asim, I knew you'd ask a smart question. It's interesting because you have the index on the numerator. No, actually, no. The idea there, if you're running a long short equities, is basically you restate everything in relative terms. So the price, the stop loss, everything has to be relative. And this is where you need a portfolio management system that accommodates that. Like all the platforms like Reuters, Bloomberg, yada, yada, TradeStation, Interactive, they all give you the absolute price, but then you have to restate it to divide it by the close on the index. You have to do a little bit of work. So shorting by the index or longing by the index to eliminate, first of all, it doesn't work. Now, why does it doesn't work? Let's say you have S&P 500. Oh, better, let's take topics. Topics has somewhere like 1,600 companies. Somewhere like 70% of the market capitalization of topics is achieved in the topics 30. As far as NASDAQ is concerned, I forgot NASDAQ, but it's like a huge amount. It's done by 10 companies. So if you want to go long some stocks and then short S&P or NASDAQ as an index, what happens is basically you are intrinsically net long beta. For those who know, for those who do not know beta, beta is what is that? Forgot, covariance versus the index. Yeah, covariance. It's a covariance matrix versus the index. Basically, the index moves like 1 point. It's basically the slope. Yeah, it's the slope of the returns of the instruments versus the index. So let's say the index moves 1%. Something that is small cap would move 2% or something like that, or 1.5. And it works both sides. This is something that cuts both ways. So now we know about like the idea, the general idea of like floor and ceiling. And why does it work? Is because this is stable. If we look at moving averages, the worst thing that happens with moving averages is stable markets, like a sideways market. All the trend followers that use moving averages, the problem that they have is like when it's trending up, great. When it's trending down, great. When it's trending sideways, they end up giving back a lot of their profit. Whereas with the floor and ceiling, there's only two regimes, bull or bear. And even when it's sideways, it comes from a bull, it comes from a bear. So it doesn't really matter. Now, the next thing, the most difficult thing for that is to find swings. And now we're going to talk about the rules for swings. And this is where it gets interesting. And again, it took me about 10 years to simplify this. And then we're going to talk about the code. So, this, I forgot, どっちだったっけ? あ、そっか。そうだね。This one is the ETF of Japan, EWJ. So I've been long. I mean, I was short. I turned around and went long. And tonight I'm going to go short. So it's my home market. So the idea there is, how do we define swing? So to define, let's go back. It is all based on swing high, swing low, swing high, swing low. So we measure peaks versus significant swings that happen here and there. Market goes up, market goes down, and so on and so forth. So the difficulty is, how do we define those swings? And this has been a quest for me for a long time. And finally, for those who bought the course, the original version was not good. So this is where we're going to go with the code. And we come up with a lagless version of it. So the idea there, it has two things: a distance test and then a retest. Now, we're going to start with the distance test. The idea is, as you can see here, there's a low, there's a high, but it's fairly close to one another, especially in high volatility. For swings to be recognized, they need to pass a distance test. They need to be significantly apart from one another, measured, as Tony mentioned earlier on, in standard deviations or in average true range. Now the retest, what is a retest? So let's follow the chart here. Up, market goes down, market goes down, market goes down, market goes down. As you can see, low, high, low, high. So low, high, going down, thank you very much. Low, high, low, high, low, high. And then low, high, and then boom. It will continue to record the low. And from the lowest low, it has to be the lowest low, and it has to be the highest high. We go subsequently and we measure first high. So the market rebounds. It doesn't take, in this case, for instance, the market rebounded, but it took the previous low, not working. goes down, goes up, but it takes this one. And in this case, it starts not to take out the lowest low. So the retest is here. Either we take the first high, either we take the latest one. So basically what happens is we take the minimum of the range each time, so that the range would actually narrow down over time. Because what happens every now and then, you have a big player who comes in, tilts gives some market impact, and this gets out of whack. It's especially relevant in day trading, intraday. So in this case, what happens is then the price goes up. So the lowest low is lower. So we don't take the lowest low. That's the condition number one. And then the close penetrates the minimum of either the first high or the latest high. So in this code, I'm sorry, the code is a complete mess, but oh no. So, right. So this is correlation done. This is here basically. It's either the first low or the lowest low. So it's index 0 or index -1. And then price crosses above. Sure enough, what we have is the market. What happens is now the bulls are in charge. And similarly, here we print a highest high, market tanks, but it fails to take the high. Trades water, goes nowhere, and it prints lows and it prints lows. And instead of taking the highest high, it starts to crack down. So it's a retest high. This is called a retest high, and this is called a retest low. And those retests, they happen everywhere. If we look at it, for instance, it happens here. It happens there. This could be bearish. But because we impose a distance test, all this is noise. And because the distance test is done in units of volatility, in high volatility, those were actually too small to qualify. So what happens, and this is an interesting chart, what happens is actually all this time around, with high volatility, the distance test was not met. There was one case where it started to be met, was here. And then there's something called runaway. But all of it is taken care of in the code. In the code, what we have here, this is pretty much an expression of that. We look at the latest one and this. So those retests, they happen quite frequently. In and of themselves, they don't have much statistical significance. But when we impose a distance test from here to there, what it says and what it says today, tonight, on a lot of stocks that we're going to see now. Let me pull out one or two. Let me pull up this one. What it says, actually this one will happen a bit earlier, but what it says here, this is what it looks like. This is the EWGA, as you can see, and poof, market gives signs of weakness. So the probability given the distance, it rallied from 37, I think, all the way up to close to 58. That's a big rally. So now the bulls are tired. So those retest highs or those retest bears, they don't have much significance when they clustered together close to one swing. But when the market has traveled quite a long distance, it just means that the market is tired. So we probably have a swing high. So this is a lagless version. So what we've experienced since March is a bear market rally. And if you assimilate the concept of the floor and ceiling, what you get to see is that, you know what, here the market tanked, but it's inevitable that it would be a rally. We print a high, that thing tanked. That thing is not going to tank forever. At some point, it will turn around and start to go up. At some point, there will be a retest and that thing will go up. At some point, we're going to see something like this. This is, what is it? We don't need to see that one yet. At some point, we're going to see Japan like this. And yours truly went long somewhere. I missed this one. I think I went there somewhere around here, somewhere around that bar. I thought I had my entry. So I went long that market because I knew that that thing tanked, and it's not going to tank forever. At some point, that thing's going to go up. So my strategy all along as a short seller was, you know what, that thing's going to go up. So I went long a lot of stuff. I went long lithium. I went long a bunch of ridiculous stuff that I had no clue. I went long Italy. I went long Indonesia. I went long Spain. I stayed short because I was already super short. I went long, what is that? Social network, social media. So that is a very good example, actually. Now I still have a tiny position compared to what 1/10 of the position that I had before, or 1/5. So what happened is we print a lot, and you can see actually the retest in practice. So here we have the retest, the price closes above, and here what we have this thing called sloppy execution. That is my specialty. Sloppy execution. This is what I do better than anybody else. Look at that. I mean, come on. I entered on the high of the day. Oh, Christ's sake. Come on. Somebody needs to euthanize me. So the idea there, the anatomy of a bear market, and this is important for everybody who wants to sell short to understand this. It took me 10 years to figure that out. Bear market rally, why do they happen? When do they happen? And why did the market rally so much? Well, there are a couple of things here. First of all, the market tanked. So out there, you have a bunch of institutionals who are forced sellers. Now, when institutions and everybody sells, and the market was frothy, yada yada, I mean, you name it, it doesn't really matter why, actually, but what matters is that it happened. Like, it doesn't matter really why you die. What ends is that you end up in a coffin anyhow. So a lot of people were forced sellers. And what happened is, if you go back, you'll see that the sentiment turned bearish, catastrophic, blah, 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 blah. People, like, you give $1,000 to people, they buy video games and guns. Great. Like, don't you supposed to feed the family? But anyhow, so a friend of mine at Capital said, like, it was gassed because people, like, the monthly sales of Smith and Wesson went up. Wow, it's terrible. So anyhow, the idea there is the sentiment, it doesn't really matter, but the sentiment went turn very, very angry, bearish, like it was the end of the earth. Next thing you know, like the earth is about to split and people are going to be swallowed in. So what happens then in this case is the selling pressure is exhausted. Everybody, the put call ratio goes to an extreme. You can see the borrow utilization spike. That's always something that I love to look at. I look at the delta of borrow as a short seller. I have to look at the short utilization, which to me is my primary indicator, short utilization. The second thing that I look at is like the delta of borrow over time. So basically, like a lot of people were shorting more. And all the institutional players are out, like they were forced out, so they don't participate. So, and then the fundamental news is horrible. So what happens is, like, because all the selling pressure is exhausted, any buying pressure tilts the stock up. So the very important thing to understand about bear market rally is that they go on much longer and much higher than most people expect. And this time around, I was caught on the back foot, but I'll explain that later. And I made a lot of mistakes. What happens is it go much longer and much higher than people expect because all the selling pressure is gone. So the way it works is, what happens is the short sellers, like a lot of guys who like, oh yeah, this is the end of the earth. Okay, let's show the shit out of it. And they start sitting on stocks. They push them down as far as they can. But then as buying pressure starts, there's basically like a tumbling domino. First shorts get covered, second round of shorts get covered, and so on and so forth. And then you get the retailers coming through. And the retailers don't really care. They usually are into punt, and they usually punt on the long side. So they start to add to the volume, and because everybody's sold, nobody's out. Everybody has already sold, so the only volume is tilted to the upside. It's always acts on the upside. And what is important then to understand is how bear market rallies end. And this is always the funny part. The way they end is basically people throw the towels out, the short sellers capitulate, and then the borrow becomes available again. And the news and the sentiment change. And if you look at the news now, it's actually funny. Like, okay, we're out of the big crisis, we got recovery. You look at Bloomberg, the AI market recap of Bloomberg. You know, when they write like, it's funny because if you look at market opening and market midday and market closing on Bloomberg, like the market recap, it's definitely AI powered articles. So markets opens up, yeah, recovery of the market, blah, blah, blah. People see past the COVID, midday's market goes nowhere. Well, it's a bit mixed. Traders are a bit waiting and patient, like the fundamentals, we're not really sure about that. Then in the closing, the market tanks. Yeah, everybody's worried about the second wave. We're talking about like the second wave for the next 2 years. So what we're talking about here is in the end, by the end of a bear market rally, everybody is on board, and it's powered by FOMO. The same institutions that sold early, they reluctantly are forced into the market. They're forced back into the market because they hate doing that. I know, because I was one of them before. I hate doing that, and we're forced into it because we didn't participate. So we're out there for the last mile. And this is right around the time when the momentum starts to get exhausted, and we have something like, what is that? Let me show you. Do you still see my screen? Yeah, something
Yes,
like
Laurent,
this.
we can see it.
We have something like this, basically. This was like the market didn't go anywhere, and then boom, the final pop, and you can see that, okay, market is trading water and so on and so forth. So people say, yeah, retailers. It doesn't matter. They're going to be on the wrong side. It doesn't matter. Some of them were retailers, some of them were in stores, some of them were hedge funds. It doesn't really matter. So the idea there is, why did we have a bull market like this? What are we in a bull market? Are we in a bear market? And why did it happen? Why was it so violent? Why did it stay so long? What we had now, we didn't have a bull market. We had a bear market rally. And in some cases, it morphed into a bull market. In some cases, it's just a bear market rally. So this rally was inevitable. If we look at this through the prism, through the framework of floor and ceiling and swings and bear market rally, this rally was inevitable. It was absolutely inevitable. It just surprised everyone by its intensity, by its duration, and by its magnitude. And the disconnect that we happened because of the economy, I think I'll leave the floor to this gentleman who will explain, Robin Williams, who will explain to us what happened. Now, after that, I'd like to talk about one last thing, the fundamentals, and then we'll open to questions. So what happened here is the market was about to tank, and then right around that time, this is when the Fed and everybody, they decided to use a nuclear weapon on the market. So it didn't matter what everybody does. Is like, when you throw so much liquidity, the market will rally. And this is something we briefly talked about before. We have a signal that works. Does it mean that it's profitable? No. It means it's profitable over time. Not all the time, but over time. So the last thing that I'd like to talk about is how to sell short, how to translate signals into order management. Now, you might have stocks that are in bull regime, bear regime, but it doesn't mean that, like, to give you a very good example here, and you'll understand better here. In this case, we have a bearish signal. That thing might tank, but if it goes all the way, if it pops around here, then we'll have a bullish regime again. And it's very likely that from overall all the markets that we see, Like let's look at a few. Let's look at a few. This you'll receive this notebook. You'll receive a cleaner version of this notebook, and along with this notebook, you'll receive this. You'll receive like a screening that will tell you this is what I do on ETF, and you'll have the same thing with stocks and so on and so forth. This is the kind of screening where it tells you, okay, this is where we have a regime, we have swings and so on and so forth. So anyhow, so the point that I wanted to make here is, okay, for the time being, this thing looks bearish. So how do you want to articulate this? You want to enter, place a stop loss around here. It goes down a little bit. Take some risk off the table. And if it rebounds around here, then it's fine. Switch side, go long. Now what we have here is we dissociated signal from order management. Order management is basically articulating the gain expectancy around a signal. Now what is gain expectancy? Gain expectancy is the number of times you win, times how much you win, minus the number of times you lose, times how much you lose. And how does it look like? And then after that, we'll open the floor to questions. Mean reversion, what we do here is basically, oh, regime is changed, it goes down a little bit. Once it does twice that distance, let's take some money off the table. Because one thing you want to avoid as a short seller is a short squeeze. So you want to take risk off the table as early as possible. Once you've done that, you've accomplished this P&L distribution where you have a very high win rate. Another way to look at it is what I did here. I went long with my sloppy execution. I closed part of the trade. I think it was somewhere around here. Yeah, somewhere around here, I think. And then that thing just happened to run. Sorry, it just happened to continue. So what we're doing here is we're trying to capture high win rate, small profits. And then what happens here, the remainder that was bought around here goes on forever. Like 1/5 of that, like yeah, it was 3,500 shares. Now it's only 700, 1/5 of the position, but that thing keeps on running. Does it make sense? So ideally, you want to have a P&L distribution that looks like that.